With recent interest rate rises, I've been wondering what makes more sense, to pay off the mortgage or invest. My current interest rate is 3.04%, but there has been lots of talk about further interest rate rises. So I wanted to run the numbers to see what might be the best option for us if interest rates were to get to 5%. Let's hope that's not any time too soon and then I'm not making a second video with an interest rate higher than 5%. Choosing to pay down the mortgage or invest will often come down to a person's risk tolerance, which is the degree of variability in investment returns that an investor is willing to withstand in their financial planning. Now, the big question is, what return should we use for the stock market, because that's a big unknown. Because the stock market return is not guaranteed. We cannot predict what the market will do in the future, and we can only estimate what the future return might be. While paying off the mortgage is a guaranteed return. If interest rates are 5%, then that's a guaranteed 5% return when paying down the mortgage. And if we look back in history, the S&P 500, which is the top 500 US companies, has returned on average around 10.5% since the 1920s. However, this is just the top 500 US companies. So I had a look in ShareSite at Vanguard's international ETF to give a bit more of a global picture. This ETF tracks international companies, excluding companies located in the United States. This ETF only has been listed for about 11 years, so I went back and had a look at the performance over the past 10 years only. The 10-year return, including dividends, has been 8.92%. This is the stock checker feature from ShareSite, which is my favorite part of ShareSite. ShareSite is a portfolio tracking tool that I use and love, and it also makes tax time super simple. There is a free plan if you have under 10 holdings, which I did use for many years. And also, if you're unsure and on the fence, you could always sign up for the free plan and see what it's like. And if you do decide to sign up for the 12-month plan, using my link will save you 4 months off the purchase price of the annual premium plan. After looking at past returns, I am comfortable using a 7% rate of return. ShareSite tells me that my current portfolio has a dividend yield of 3.90%, so that means I only need a 3.10% in capital growth to get that 7% return. In my example today, I'm going to run with my own personal numbers. With a mortgage of $300,000 and an increased interest rate of 5%. We do save $50,000 a year, and as I said, I'm going to use a 7% rate of return. I know not everyone has $50,000 per year to invest, and we didn't either when we first started out. So I'll also run these numbers with lower amounts to see where the numbers fall to. So of course I must mention, the information in this video is for entertainment and general information only. It's not financial advice. You can read my full disclaimer in the description box below. So I inputted the numbers into my favorite mortgage calculator. There will be a link in the video description. So that's a $300,000 mortgage over 30 years with that increased 5% interest rate. And with just paying the minimum amount each month, the total amount paid towards the mortgage would be $579,765 over 30 years. In that example, that means that $50,000 that we are saving would go into the stock market over 30 years at a 7% investment rate. This is the compound interest calculator from Money Smart, and I will leave a link in the video description. And with those numbers, the portfolio could grow to $4.72 million. And after 30 years, we would end up with a paid off home and an investment portfolio that could be worth $4.72 million. And the total contribution, which was what was paid into the mortgage and invested, would be about $2.08 million. Now in scenario 2, if we pay extra off the mortgage and then invest after the house is paid off, we would end up saving $241,000 off the mortgage. And this would save 25 years and 1 month off the mortgage term. And the total amount paid towards the mortgage would end up being $338,767. So with paying the mortgage off first, it means that the mortgage is paid off within 5 years. So that leaves 25 years for investing. And then the amount contributed for investing will be the mortgage repayment plus that $50,000 contribution, which equals just over $69,000. So I added those amounts into that compound interest calculator. And in that scenario, the portfolio could be worth $4.38 million. So after 30 years, we still have a paid off home and an investment portfolio that could be worth $4.38 million, and the total contribution of $2.12 million, which was slightly more than paying minimum off the home. And of course, if you are enjoying this video, don't forget to give it a thumbs up or write a comment, because it really does help to support my channel. So the overall numbers show, if we were to pay extra into the mortgage and then invest after it's paid off, the total gain could be $2.26 million. And if we were to pay the minimum off the mortgage and invest the entire time, the gain could be $2.64 million. That's a total difference of $380,000. Something that these numbers do not consider is tax. Paying off the mortgage is most likely not a taxable gain, while investing gains might be taxable. But this might only be the case if you sell, depending on where you live, of course. Something else we are doing is borrowing to invest, so I also need to run those numbers. That will be in another video, so make sure you're subscribed if you want to see that video. Okay, so what about contributing less than $50,000? So in this example, I'm going to keep the mortgage details the same, and I will run the numbers for contributing $5,000, $10,000, or $15,000 a year. So paying the minimum of the mortgage will stay the same at just under $580,000. And after 30 years, the investment portfolios could be worth $487,500 contributing $5,000 a year, just under $975,000 contributing $10,000 a year, and $1.46 million contributing $15,000 a year. Now, what about if those amounts were paid into the mortgage? With $5,000, the total amount contributed for the mortgage would be $467K, and it would save just under 12 years off the loan. With $10,000, $421,000 would be paid into the mortgage, and it would save just over 15 and a half years off the loan. And with $15,000, $395K would be paid into the mortgage, and it would save just under 18 and a half years off the loan. So now let's see how much the portfolio could be worth if we were to invest the mortgage payment and the extra savings. I used a different compound interest calculator for these calculations that allowed me to input months into the time period. And it might just be my new favorite compound interest calculator. So with investing $5K extra and the mortgage repayment over 10 years and 9 months, which was the time saved off the loan, the portfolio with a 7% investment return could be worth $383,000. I'll leave a link to this calculator in the video description. So comparing the two options, paying the minimum off the home and then paying extra off the home and then investing, the total contribution worked out to be about the same. And after 30 years, both cases would result in a paid off home. And then paying the home off first and then investing would result in a portfolio that could be worth $383,000, while paying the minimum off the home and then investing could result in a portfolio worth $487,000. That's a difference of $103,000. And then with $10,000 and the mortgage repayment invested over 15 years and 7 months, the total value of that investment portfolio could be worth $808,000. And then with contributing $10,000, the total contributions again work out to be pretty similar. And after 30 years, we have a paid off home again. And then with paying extra off the mortgage and then investing after that, the portfolio could be worth $808,000. While paying the minimum off the mortgage and investing the entire time, the portfolio could be worth $974,000. That's a difference of $166,000. And then with the $15,000 plus the mortgage repayment invested over 18 years and 5 months, the portfolio could be worth $1.25 million. And again, the total contributions work out to be pretty similar. And after 30 years, again, we have a paid off home, and with paying off the home first and then investing, the portfolio could be worth $1.25 million. And with paying the minimum of the mortgage and investing the entire time, the portfolio could be worth $1.46 million. That's a difference of $208,000. In all of these scenarios, paying the minimum of the mortgage and then investing came out ahead. But it's very important to recognize that these numbers don't measure some of the other benefits that can come with paying off a mortgage. These numbers don't measure the psychological benefits and emotional relief that can come with paying off a mortgage. These numbers don't measure financial security, peace of mind, and that sleep night at well factor. They also don't measure the opportunities that could arise to pursue other life goals that could come with paying off a mortgage. What are your plans with current interest rate rises? I would love to know. Let me know in the comments below. Thanks for listening. Don't forget you can also find me on Instagram and Facebook.